All right. Brother John, are you able to unmute yourself?
I believe I'm unmuted. Can you hear me?
Yes. Yeah. Brother Bill, I'm going to mute you. Any questions in the end, okay? So now it's just going to be Brother John. So I'm muting everybody again. All right, Brother John, you're on. We have our 20 participants. All right. So thank you, everybody, for joining us tonight. Our first business networking AHEPA Hermes Chapter 186 lecture with our own past president and treasurer, Brother John Kokolakis. He's one of the first people I met when I joined the Hermes chapter after I came from Delphi 25 in Manhattan with Brother George Zuvelos. They introduced me to this wonderful chapter in Astoria with its deep and rich history. And Brother John has been a pillar of this chapter. And he's a very knowledgeable person, and especially in law and real estate. And we're going to find out a lot about this very interesting subject. I'll be admitting people throughout. We have another person who just joined us. We just ask you, except for Brother John, to mute yourselves. You can ask your questions in the very end. Girls, please keep quiet. All right, I think that's it. I'm gonna start with introducing Brother John, and I think we're good. All right. You can show yourselves if you like. We'd love to see your faces. You can say hello in the end. Brother Peter Agiropoulos, our vice president, is gonna. If you have questions, you can use the chat aspect of the Zoom conference, and you can type in your question, or in the end, and we will read them. Or you can just unmute yourself in the end and ask it directly, whatever you feel comfortable. So we had a very successful cultural event 2 weeks ago. My group Porphyra played Athens Square Park, which was sponsored by our chapter and the Athens Square Park Committee, where Brother Zuvelos is in charge of also the marketing. And we had a rock opera that we performed in Carnegie Hall and off Broadway, and we brought our musical and to Astoria in an outdoor concert. We played music from all 3 albums and the musical Anna and Vladimir, The Love That Rocked the World. It's a Byzantine-themed rock opera. So thank you all who came. Thank you to our chapter for sponsoring. It was very successful. I think we had over 250, 300 people there. It was wonderful. The sound was amazing. And hopefully we'll be able to do more things like that. So you can see Porphyra online, Porphyra, band.com, Facebook, YouTube, anywhere all over the digital internet world. You can purchase the album or listen to it, iTunes, Spotify, and so forth. So we decided to also do our first business networking meeting, and this is what this is. We do culture. We also do business, and hopefully in the future we'll also have that aspect physically as well. Due to the coronavirus, we deemed that it's easier to do it online, and it's the summer for everybody to be able to join in. But we'll also be doing these kind of lectures also in our own chapter office in Astoria very soon. So this is our first one, and we're thrilled to have Brother John Kokolakis talk to us tonight. He has 22 years experience practicing law, emphasizing on residential and commercial transactions and litigation deriving therefrom. John Kokolakis earned his undergraduate degree from Queens College and his Juris Doctor in Hofstra University School of Law. He is admitted to practice law in all the state courts of New York, as well as the federal district courts of the Eastern and Southern districts of New York. He's also admitted to the Connecticut bar. Mr. Kokolakis is a former managing auditor and community associate to the city of New York, while conducting performance audits of city agencies and private contractors contracted by the city. He learned to pay attention to detail. His position as a legislative aide to a New York senator allowed him at an early age to research, analyze, and draft state legislation. He represented the senator at political functions and in various committees. Further, he responded and addressed concerns from constituents. His attention to detail and his ability to negotiate and know for compromise allowed him to serve those positions well. So John Kokolakis has served also as past treasurer and president of AHEPA Hermes Astoria chapter 186. His website is kokolakislaw.com. That's KOKOLAKISLAW.com. And tonight's theme is what is the 1041 exchange and will it survive? Brother John, I give you the floor now.
Brother Billy, thank you very much. Our current president, I wish you a wonderful year, 2 years, 3 years, depending how many years you wish to serve as president of our chapter, right? I'd like to say hello to some of the other brothers who are here and all the other members. Thank you very much for attending on our first business webinar. And without further ado, let's get started. But before we do, I'd like to give you a bit of a disclaimer, right? Because everything here is for informational purposes only. I may be an attorney, but I'm not necessarily any of your attorneys with regard to any 1031 exchanges. Also, you know, some of the things that we discuss here may not be the correct option for everyone. So I always emphasize and advise that you seek your personal attorney or tax advisor as the case may be. As you're aware, and by agreeing earlier, this webinar is being recorded, and by continuing to remain in this webinar, you're consenting to be recorded. Okay, so what are we going to learn today? The current administration's plan under the Biden administration, there are some proposals to change Section 1031, and this created the 1031 back to the forefront. And this is why we thought it was important to discuss this 1031 exchange today, because once again, it's become hot. Now, many times people consider the 1031 a loophole, but it is definitely not. It is part of the IRS code. My goal today is to contribute to this dialogue by first discussing the basics of the 1031 exchange, its process, and thereafter the proposed changes and the potential tax ramifications. So we'll go into the procedure, we'll go into some definitions, and we'll then conclude with the question and answer session. What is the IRC 1031 exchange? The 1031 exchange is named for the IRS tax code under IRC 1031. And it allows real estate investors to, among other things, defer federal capital gains and state tax on the sale of replacement of like-kind investment property if certain criteria are met, right? And we'll discuss that criteria further on today. As we go little by little, we'll be touching on different aspects. Okay, give me 1 second. I'd like to remove this. Okay. So in order to have a successful 1031 exchange, there are certain guidelines that need to be met. One of those is with regard to the type of property. So we're dealing with a like-kind real property, which is held for trade, business, or for investment. Tax deferral, right? So we're not looking to avoid taxes. We're not able to avoid taxes, although there may be a few ways to do so, and we'll touch on that towards the end. But for the most part, it's designed to defer the tax. So we purchase the replacement property equal or greater than the net sale price, and we roll over all those proceeds and the debt over into the second property. By doing so, we would defer the taxes. Now, in order to do that successfully, we're met with a particular timeline. And so we have 45 calendar days to ID a replacement property and 180 calendar days to complete the exchange. Both times begin at the close of the relinquished property, okay? And then there are certain identification rules that need to be met, which we will explore as we move deeper into the webinar. Okay, I'd like to touch upon capital gains. What exactly is it? It's a profit realized from selling the capital asset. When a capital asset is sold, for example, we have a home, and let's say we have a 2-family home. When that's sold and the sale price exceeds the purchase price, so if we bought this home for $200,000 and now we sell it today for $1 million, the difference between the amount we paid for the asset and the amount we sold it for is our capital gain, which would be the $800,000. Now, I'm simplifying this a bit because I'm not going into actual depreciation and other aspects, just so that we get the basic idea. Now, we also mentioned earlier that we're dealing with a like-kind property. So what exactly is a like-kind property? Many times people confuse the fact, well, if I have a 2-family, do I have to replace it with another 2-family? Or if I have a condominium, do I have to replace it with another condominium? And the answer is no. What we're looking for more so is to the nature or character of the property. For example, if I have an investment property, I can replace it with another investment property. So the specific type of property is not essential. And the IRS is very broad and liberal in how they define it. And we'll go over a few more examples as we touch upon the next slide. But the key part here is that it has to be used for business or investment and trade as well. And also, we have certain confinement as to where the properties can be located. So they can only be located within the 50 states, DC as well, or the US Virgin Islands, okay? And we can buy or sell multiple properties. And what I mean by that is I can have one property that I sell for $1 million, and then I can buy 2, 3, or 4 properties. Or I can have 2, 3, or 4 properties and sell them and buy 1 property. So we do have some flexibility. Going back to location, we cannot purchase, or rather sell a property here in the United States of America and then decide we want to purchase a property in Greece, for example. We can do so, but that would not allow us to have a successful 1031 exchange. So like kind of examples is if we had a hotel for an office building, or an office building for a shopping center, a condo for a warehouse, an industrial building for a multifamily, an unimproved property for an industrial building. So as you see, we're very, very flexible and liberal in what like kind would be. The key aspect is the business or the investment nature of the property. Now, examples of non-like kind real estate is inventory or stock and trade. So ideally, it has to be a real estate property. So even stocks, bonds, or notes, or partnership interests, non-real estate assets would not work as a like kind of real estate. When we go back to stocks, bonds, or notes, one question that comes up is when we're dealing with a property, or we're dealing with land, or we're dealing with a condominium, in the eyes of the law, those are considered real estate. Now, we also have, especially in New York, many co-ops, cooperative apartments. Those units technically are shares. They are not considered real estate. However, for purposes of a 1031 exchange, the IRS will recognize them as real estate. So a co-op will be considered a like-kind property. Now, a personal residence is also a question I get asked frequently is, well, can I do a 1031 exchange on my home where I live in? And the quick answer is no, especially if we're dealing with a one-family home, unless we convert that into an investment property, and that's something we can touch upon later as well. Also, another caveat would be if I have my personal residence and I'm in a 2-family or a 4-family or a 5-family or something else, then we would be able to do a 1031 exchange. However, we carve out the personal resident aspect. So if it's 5 units and we live in one of those units, that one unit would not work for purposes of the 1031 exchange, but the other ones would, and you'd work with your tax advisor on how they would break that up. Now, what we have here is I want to just take what we discussed as far as the properties and work this out a little bit as we further define it. So first, what we have here is we have the relinquished property. So let's assume I have a 2-family home, and this 2-family home has reached the value from the $200,000 that I purchased, and now it has a value of $1 million. Now, this $1 million, I want to utilize that, and I want to buy another property, which would be my replacement property. What I want to do, however, is I want to sell my property, I want to purchase the new property, but I do not want to pay capital gains. So for example, if I sold my property for $1 million and I picked it up for $200,000, I'd be hit with an $800,000 capital gain. And then I'd have to pay a percentage off of that. And I want to see if I can avoid that. In order to do so, which we can through the 1031 exchange, I would sell the property. One of the conditions is I cannot touch the money, right? So what we do is we have to hire a qualified intermediary. The qualified intermediary would actually take the money and hold that money. And then when we make the purchase, the qualified intermediary would wire the funds or send the funds over to the seller on their replacement property, okay? This transaction is going to give us the exchange. Now, in order to successfully do this, we have to find our qualified intermediary. We have to do certain exchange agreements and assignments before the actual closing of the property. Now, generally, the person who's wishing to relinquish a property and get another replacement property, especially in the state of New York, they're going to require an attorney. So they're going to hire an attorney, and that attorney is managing the transaction over here, which is going to be a sale. So now we have the person who, the taxpayer, let's call them the taxpayer because we want to identify them as such. That taxpayer is going to sell the property. They're going to hire an attorney who's going to facilitate that. They're going to locate a buyer, but the attorney cannot touch the money either. Now, there's an exception on original down payment, but that we'll touch upon later. So that money has to go to the qualified intermediary who's working in conjunction with the attorney and working in conjunction with the taxpayer. Now, the same thing over when we go to get the replacement property, we still now have the attorney. Now, in this time, the taxpayer is actually the purchaser of a property, whereas here they were the seller of the property, okay? Now, in order to do this, we actually have a timeline, which we touched upon earlier. So we have day 0 when we close on the property. So once we do the transaction and we complete this transaction, which is called closing of title, at that point, the clock starts to tick. And that's when the clock is gonna keep running, and we have 45 days in which to identify a replacement property. We have 180 days in which to close on that property. So if we do not close within 180 days, our 1031 exchange will fail and we will have to pay the capital gains taxes. If we don't complete our identification within the 45 days, our 1031 exchange will fail and we will have to pay the full capital gain taxes. Moving on to the identification rules. So we decide that we're going to sell our property, and we've sat with our tax advisor and we've sat with our attorney, and we realized that we're going to have a capital gains. And we've decided that we want to expand our portfolio, and in order to defer the capital gains, we want to purchase another property following the sale, and that is our replacement property. In doing the replacement property, what we have is one of three ways in which to identify, and these have to happen within the 45 days. The three property identification rule is whereby we can choose up to three properties. We have to clearly identify those properties, the state, the city, the location, the actual street address, and we can identify up to three of them. We do not have to purchase all three of them, but we have to purchase at least one of them. And the reason why we would like to identify three is because sometimes something may happen and the deal falls through. So we want to have a backup property, okay? Now, there are certain situations where we would want to identify more than three properties, and that would get us over into our 200% fair market value rule. Going into the 200% fair market value rule, we can identify more than three properties, 4 properties, 5 properties, 6 properties, provided that we do not exceed 200% of the sale price of the property that we sold. So 2x. So for example, if we sold the property for $1 million, we cannot identify properties that would exceed $2 million. Okay. Now, if we were in a situation where we wanted to identify even more properties and we don't want to be bound by this 200% rule, then we can actually jump into the 95% identification exception. In this exception here, what we can do is identify 2 properties, 5 properties, 6 properties, 7 properties, irrespective of the value of the properties. The caveat and the condition here, however, is that we now have to purchase 95% of the properties. Now, for all intents and purposes, that really equates to 100%. For example, if we're dealing with $1 million that we have to spend and we have multiple properties, we're not really going to find a property that's worth only $50,000. So in essence, we're going to have to buy them all, right? This is the least used, at least in my experience. Primarily, we deal with the 3 property identification rule. Then we jump over into the 200%, and then over into the 95% identification exception. When dealing with the 3 property identification rule, you do not have to buy all 3 of the properties. You could buy 1 of them, 2 of them, or all 3, depending on the actual funds. And with regard to the 200% FMV rule, also you do not have to buy all of the properties. But for the most part, it looks like you do with regard to the 3rd identification category. Now, the benefits of the 1031 exchange is we have preservation of the investment capital. As you can imagine, now we get to defer our taxes. So that means we have more buying power because we get an immediate tax deferral, and that extra money can get put towards the replacement property. So we can buy a bigger and more expensive property, right? And that emphasizes our buying power. It also creates new cash flow. So for example, if we're in with the 2 family and we have a certain level of cash flow on a monthly basis, by now jumping into our replacement property, which is a 6 family or a 12 family, for example, or something larger, we've increased our monthly cash flow, right? And we have the possible elimination of the gain, right? So estate preservation with a stepped up in basis. So estate preservation with a step up in basis is one way where we're not only deferring the taxes, we can actually avoid the taxes. So for example, if we purchased our 2 family and we purchased that 2 family for $200,000, and now we are purchasing a replacement property for $1 million. Now, if we were to sell that property for the $1 million or more, we would get hit with the capital gains from the original basis on the first property. So we'd be at the 200,000 tax basis. Now we can do an additional 1031 exchange and continue to do replacement properties, relinquished properties, replacement properties, and keep deferring. But if we then finally sell and we do not have a replacement property, then at that point in time, we will have to pay all the taxes that are due. One way to avoid that is to continue to do the 1031 exchanges. And then at that point in time, if we were to pass away and our family inherits, when they inherit the property, they will get it with what's called a step up in basis. They will inherit it at a current fair market value, not at the 200,000 original cost basis, which means we essentially, in that situation, are avoiding the taxes, which is a wonderful benefit. And then you have an overall economic benefit, because generally, because of the 1031 exchange, it promotes the selling and purchasing of properties. And that generally is healthy for the real estate market as a whole. Now, what we have here is proposed tax reform. So we have the elimination of the 1031 exchange. Under the current administration, Biden's administration, there are certain proposals not to eliminate the 1031 exchange, but actually to limit the exchange. And they propose to limit the 1031 exchange to $500,000 in gain per taxpayer and per tax year, and $1 million in gain per tax year for a married couple filing jointly. So now, on the one hand, this may not sound so bad, because you figured, okay, I'm going to be looking at a $300,000 tax burden as opposed to the 800. Now it'd be at the 500,000. However, what's also within the proposed changes is the long-term capital gains to be taxed at ordinary income tax rates when we're exceeding the $1 million. So that would essentially bring us close to 39% tax bracket. And this is something you'd want to discuss with your tax advisor. And what we'd be looking at, if we do some rough math, earlier we had the 800,000 capital gains. We're able to defer that. Now we would be able to defer the 500. We'd be stuck with the $300,000. From that $300,000, and we're looking at around, not taking into consideration the individual state, but looking only at to the federal level, we'd be looking at around a 39% tax rate. So effectively, you take the 39.6 plus you would have a 3.9, which is a net investment tax that we were hit with a number of years ago, I believe under the Obama administration. You'd be looking at times that up to the 300,000, and you'd be at 130,500 of a tax, which means that's $130,000 less that you have to apply to the next property. So the question then becomes, well, what do we do? Do we do our 1031 exchange now, right away, and get it out of the way before these laws take effect? That's one option, right? As of right now, we don't know when these new changes will take effect, or even if they will take effect. If I were to guess, I do not see them taking effect sooner than the fall of 2022, although within the proposal, they are stating that it will trigger in December of 2021, which means it may impact us also into the tax year of early 2022 as well. But because these proposals did not become law as of yet, we don't know, right? So it's possible even if it passes and it becomes law and gets signed into law, even into 2022, we don't know when the effective date would be. In the past, when there've been certain changes, sometimes they've triggered to be 6 months or a year thereafter. Now, the 1031 exchange is not new. We've actually just hit our 100 years of this being in the books, right? I believe it was 1921, roughly, give or take. And in its present form, 1984 to 1986, is when it did change to the way we see it today. And there have been little changes over the years. So as of now, I don't think we should worry immediately, but it is something that we are keeping our eye on. The way the market is now, it may be something you want to do sooner rather than later, because if these proposed changes take effect, they also may be changing the step-up basis that we discussed earlier. So there's talks and there's a proposal to eliminate the step-up in basis as well. If that were to happen, when we have our 200,000 and we jump over into the million, we'd be at zero tax, because we would defer that immediately. But if these proposed changes come into place, based on the calculations we did before, we're looking at 130,000 price tag. Now remember, that does not take into consideration, for example, the state of New York. So on top of those taxes, the state of New York can hit you based on your bracket anywhere from 0 to 20% additional. That's an extra hit. That's why this is something that's very important to take into consideration and keep your eyes on, and let's monitor it and see where we are. At this point, we actually ran a little faster than I anticipated, but I'm sure there may be some questions. I'm also being told that there may be some static here, and I hope everyone was able to hear me. But if anyone has any questions at this point, now's the time to type them in the chat. Or if you want, Brother Peter, if you're able to, you can unmute if someone wants to directly ask that question.
Okay. If anybody has any questions, I'd be more than happy to relay them. If not, we can unmute you and you can ask it directly to Brother John.
Okay.
Marianti has a question.
I see here, Marianti, you're asking, when can we move into the investment property? Okay, so generally speaking, you wouldn't be moving into the investment property because it's investment property. It's not your personal residence, right? So in this situation, however, it raises the question more so, can you move into the investment property? Well, in order to move into the investment property and let's say convert it into your personal residence, first things first, we have to take into consideration that the 1031 exchange is for investment properties. So that means our intent when we did the exchange was from investment for investment, not to move in. However, life happens, things change, we can end up with negative cash flows, we can end up with deaths in the family, we can end up with divorces, where all of a sudden we're stuck with a scenario where we're forced to have to move into the investment property. So in that situation, we can convert it. But in order to do that, there's no specific time frame in the law as far as what we would call safe harbor. Some tax advisors and attorneys would argue at least 1 year. I would actually be more on the conservative side of that, and I'd want to say 2 years. There's some memos and case law that would support both for different reasons. But generally speaking, you do not want to do it less than the 1 year because that would put you into a short-term category as opposed to the long-term. And then when you do that and you move in, Also, you want to hold that property for at least 5 years so that the IRS does not trigger, fail the exchange, and get you to pay the capital gains. Does that answer your question, Marianthi? I guess so.
Yep. Okay, we got another question from Elvis. We have, can we cash out Refi most of the equity of a property and then sell shortly thereafter for a smaller capital gain?
Okay. Elvis. Yes, you can refi, right? You can pull out the equity and then sell shortly thereafter for a smaller capital gain. However, the problem with that is even though you can do it, remember at the beginning we were discussing we need to roll over all the proceeds and the debt. So in other words, if we now have less equity and we have a larger debt, that debt has to transfer over. So we're going to need to take a similar mortgage on our replacement property, or a little known fact is we can pay off that debt from separate non-exchange funds prior to the transfer, at which point we then wouldn't have to take the mortgage. But if at the time we're doing the transfer, we have that debt, we have that mortgage following the refi, we're gonna have to match that and roll everything over. So in other words, yes, it could be done. 2, we would have to roll over the proceeds and the debt. If we do not roll over the debt, we'll have what's called a boot, and we'll actually have to pay taxes on that difference. And that's something we want to avoid. Otherwise, it defeats the purpose.
Okay. Okay, we have another question. The question is, it was mentioned that a residential property would have to be turned into an investment and then qualify to 1031. Is there a time frame or something specific that needs to be done?
Kind of. So generally, again, we're going into the conservative side. And the reason I'm pausing for a moment is because by doing so, we can actually take advantage of Section 1031 and also Section 121. So let me explain. If we have a residential property, what we have is we have a $250,000 credit off our capital gains or $500,000 credit if we're a married couple. So let's assume we're single and we have a $250,000 cutout that we will not get taxed on. We don't want to lose that. So first, what we would have is we would convert our residential property, we turn it into investment. So for example, if it's a 2-family and we're now not living in it, or even if it's a 1-family, we rent that out. So we're treating it as investment. And while we're doing that, I would like to have it for 2 years. I always like to have 2 years as my safe harbor. However, I don't want to exceed the 5 years if I'm going to then sell the property. Because then what I could do is I could take my 2 years. On the 3rd year when I sell it, because out of the last 5 years, it was residential, I'll get the $250,000 credit. And then on top of that, I can have the 1031 credit that I would be able to defer over into my replacement property. Now, an argument could be made that you can do it following the 1 year, but I still would like to see that 2-year mark.
Anybody have any questions?
If whoever has that background noise,
Can you mute?
mute yourself, please.
Okay, I think we're good. All right. Any more questions here? Okay. We have another question from Marianthi. It says, I just noticed on your website you have an ebook on the 1031 exchange. Can this possibly be emailed?
Yes, sure. For all in attendance today, I can actually email you. I actually have a copy of it right here, Closing the Deal and Building Your Wealth. There's a section here on 1031 exchanges that touch upon some of what I discussed today, and it goes into further detail in some other aspects. It does not, of course, touch on the new administration proposals, but it also goes into the basics of purchasing a property and on getting mortgages and refinance. So whoever puts their email in the chat box and states 1031 exchange, we'll turn around and we'll email you a free PDF.
Great.
Okay, does anybody has any other questions?
What is the current rule of capital gain for New York State? Is this changing anytime soon, Stella?
Okay, so Stella, the capital gain is actually on a federal level. Right now, I'm not aware of any change with regard to New York State. New York State generally will have between 0 to 20% on the capital gain side for long term. Okay. Now, what triggers is if we did a capital gains on the federal level, we will not be subject to the state level. However, if we're not able to do it on the federal level, then we will be subject on the state level as well. I hope that answers your question. And if not, if you have a follow-up question, let me know.
Please keep on asking them. Emails. Any more questions? You can unmute yourself. Type it.
Yeah, actually, I think I got a question for you, Brother John. Touching back to if someone, this is new to me, so I'm trying to understand. If someone has a home and they're turning it into an investment property, and you said keep it for 2 years, is there anything that has to be done legally, paper-wise, to show that that's no longer your permanent residence and it's your investment property? Is that done tax time or immediately as soon as it turns into an investment?
Couple of things. One, it's going to be how you're declaring it and listing on your taxes, on your tax return. Two, think about it in terms of if you were to convert your home into an investment property, what would you generally do? So generally, you would, let's say if it's a 2-family home and you're no longer there, you would rent it out and you would get tenants. So
Right.
You would document that you have the tenants, you would have your leases, you'd create a folder and a paper trail.
Right.
On top of that, a side note, something I didn't touch upon earlier, is you're also going to want to keep good receipts and records as you're working with your tax advisor for purposes of depreciation, because there's also part of the taxes we didn't touch upon is depreciation recapture, which is about 25% on the federal right now. So you want to be able to defer that as well. But that is on a case-by-case basis when you're dealing with a tax advisor.
Excellent. Okay, great. Okay, we got another question. We have what would be a good ballpark figure of capital gains should I be getting before I consider initiating a 1031 exchange?
Patrick, you want to unmute yourself? Because I'm not, it's a little confusing of a question.
Yeah, sorry, John. What I'm saying is I know that you're allowed to make a certain amount of capital gains and then you don't have to pay taxes on it, something like that. I'm not entirely sure.
Okay, so we touched upon that a little bit earlier with section 121. You would not have to pay taxes if it's your primary residence. If it is not your primary residence, that would not apply. If it is your primary residence, then the answer to your question would be $250,000. So the first $250,000 is not a capital gain if you're single, and $500,000 if you're married. However, if it's an investment property, that will not apply.
Thank you.
You got it. Thanks for the question. Any other questions? Right? That doesn't mean I did such a great job.
That was really great.
Thank you. I sped through that a little bit. If there's any clarification anyone needs on anything that I discussed, feel free to ask that as well. Okay.
Okay, we have a question. What if a property is invest but later becomes your residence?
Okay, so Stella, you want to unmute yourself so we can get a little clarification on the history of that?
So what if you have a property from like 10 years now and it's investment, but then later on in life, you decide, okay, I want to live there. And so do you still, is it the capital gains for the 250 apply, or is there a time frame or like a 2-year or 4-year?
Yeah, so if we have a current property, it's an investment property, and we've had this for a number of years. And now what we do is we want to convert it to a residential property. Now, the reason why I asked you to unmute yourself is because there's no sale here. Are we looking to sell the property? Because if we have an investment property and we just convert to a residential property, there's no tax trigger. The issue becomes, if we do go to sell it, at what point would we want to sell it? So usually what happens often, and this happens frequently nowadays, is because a lot of the properties, especially in New York, over the last 10, 20 years, I've built up a tremendous amount of equity, right? So you basically are having many people who are millionaires overnight. They have a $300,000 property and boom, it's now worth $1 million. And so they realize that if I took my $300,000 property and I were to sell that property, I would only get a $250,000 credit. That means if I took my 250 and I have my 300, I have my $550,000. The difference between the 550 and the million, which is the 450, I'm going to get taxed on. So like, whoa, how do I avoid that? So one of the ways to avoid that is to convert the residential property into an investment property. Then we hold that for 2 years, for example, and then thereafter, we now sell that property and we purchase another property. If we do that, we'll be able to take advantage of Section 121. And in your scenario where we're married and we have the $500,000 that will come off, on top of that, whatever the difference is in the capital gains, we're deferring that into our replacement property. So it's kind of getting 2 bites of the apple. Answer your question?
Yes, thank you.
My pleasure.
Okay, we got one from George. Because can a primary residence 500K exemption be used more than once? Example, if you sell your next personal home, can you still apply another credit?
Good question. Not related to the 1031 exchange. I believe the answer is yes. And I actually think that is the first time that I've ever been asked that question. So I would double check, but it makes sense for the answer to be yes. And that would fall again under Section 121.
Any more questions?
One of
Anybody got
the-
any more?
If anyone has any other questions, feel free to either raise your hand or put it in the chat. But one thing I'd like to mention is that didn't come through earlier is taxpayer, right? So we're dealing with an individual, taxpayer to taxpayer. So then the next level is, what if we have LLCs, corporations, or C corps or S corps? And if we have a corporation as the tax-paying entity and it wants to engage in a 1031 exchange, it is welcome to do so. The IRS permits that. If it's an LLC, the IRS permits that. Where we have a problem that arises sometimes is we have an individual who owns a property, and let's say they have it for the $200,000, and now they have it as to $1 million, and they want to buy a replacement property. Then what they do is on the replacement property, they want to form an LLC and give themselves some protection. That is a potential problem. The reason that's a potential problem is because now we're dealing with two separate entities. We have the individual and we have the LLC. One way where you could make that possible is if we have a single member disregarded entity, and then we may be able to do that if we're single. If we're married, we may be able to do it in certain states that are community law states, right? So that's one thing to be careful of. And the same thing arises if we have, let's say for estate planning purposes, we have a trust, whether we have a living trust or a revocable living trust, or as opposed to if we had an irrevocable trust, depending on how that is set up, that can be a potential issue. On the flip side, where this becomes an issue is sometimes we have an LLC that owns the property, needs to sell, and also now does the purchase. On the face, that's fine. For purposes of IRS, that's not an issue. Where it can become an issue, especially lately, is many banks, 80 to 90% of the lending institutions that we're dealing with today will not lend to an LLC. Now remember, as we discussed earlier, we also have to roll over the debt, which means if I roll over the debt, I need to get a loan on that replacement property, and many banks will not lend to the LLC, right? And that's where we have to deal with certain banks who are familiar with these programs and will be able to do that. We actually have Elvis in attendance who has been able successfully to do those loans. So if anyone's interested, feel free to send me a request by email and I can always connect you with Elvis, right? With regard to that. And I know this personally because he's actually working on a deal with one of my clients successfully. He's doing a great job. So thank you, Elvis. That's a little shout out. Okay. So that becomes very important because sometimes what happens is they'll form the LLC thinking everything is okay, not confiding. This wouldn't happen so much in New York because you're going to have an attorney on the outset, and especially if they're a seasoned attorney, they'll know to stop you before you do the transfer. But otherwise, especially in other states, that can happen. They go to do the taxes and they realize they have an issue. The 1031 exchange failed. Okay. Also, a question that comes up frequently is, what if I don't want to roll over all of the proceeds? What if I want to keep some of the money? Okay. I want to have some cash because I want to go to Las Vegas and play a little bit. And so many times people will think, well, then the 1031 exchange fails. It does not. You can actually do it. It's called a partial exchange. The caveat, however, is the part of the money that you do keep is taxable. So you will have to pay taxes on that part that you do keep, but the other part that follows through into the replacement property, that can be deferred over, and we call that a partial exchange. Okay. Bill Kent, caveat emptor. Yes, in the state of New York, I would say the caveat emptor is prominent. And this is why you should have an attorney represent you when you're purchasing and when you're selling a property, especially in the state of New York. I mean, there are certain laws that would require it, especially when you're going to be drafting the deed. But the certain states, for example, Florida and California, the system is such that you can actually do a closing through a settlement agent and not have an attorney, and the real estate agents would play a more active role than they would in our state. But again, we're digressing to other sections outside of the 1031 exchange.
Okay, great.
Any other questions, anyone? I'm scrolling, I don't see anything here.
Any more questions? Anybody? All right.
Okay. What just came to mind, and I'll mention this, is when we're dealing with the sale of the property and we need to then do the replacement property, remember we have 180 days. Now, these 180 days are very, very strict calendar days. If it falls on a Saturday, if it falls on a Sunday, if it falls on Christmas Day, it does not matter. You have to complete the exchange and do that closing by that 180th day. You can't extend it. The only exceptions we did have is during the pandemic. There was a small extension up until July. And we did have an extension of that, I think in Texas, when they had the storms, because there was a declared emergency. Very, very rare. Okay, so be careful. The 45 days, the 180 days, they are set in stone. Now, what you can do by mistake is shorten the 180 days. And the reason you can do that is if you actually have your taxes due and you filed your taxes from the sale before you made the purchase, you will actually shorten your 180-day window. So whatever you do, do not file your taxes if they are due until you've purchased the replacement property, which means if taxes are due, make sure through your tax advisor that you get an extension to file your taxes. That is also a mistake that I see frequently, and it's a shame because you think you're doing everything correct, only to be hit with that surprise after the fact, and it's too late. You can't go back. Okay. Who keeps tabs on the 45-day identification process? The IRS? No. This is a question that Elvis is asking, and that's why we have the qualified intermediary. So we actually have a certain form that we complete, we fill out, we send that over to the qualified intermediary. They document it, they keep it for the file. In the event anything needs to be proven with regard to the IRS. That's why we should have that qualified intermediary who's that neutral party to make sure that we do not touch the funds. Again, touching on what I stated earlier, what used to be done many years ago incorrectly is sometimes attorneys would think that they can hold the funds and they'd hold the money in escrow. And they say, oh, look, I'll hold the money in escrow. My client's not holding the money, so I'm protected. They did not touch the money. We can have a successful 1031 exchange. Unfortunately, that is not the case. If your attorney is holding the money, you are deemed to be in constructive receipt of that money. And the reason why is because the attorney is holding the money in escrow. It's not the attorney's money. He's holding that money in escrow for you, which means you can control whether that attorney will give you the money, not give you the money, give you a portion of the money. So you do not want to have the attorney hold that money in escrow, which is why you have the qualified intermediary. Hope that answers your question. Okay.
Another one from Elvis. So the 1031 exchange company intermediary are accounts.
No,
Accountants?
they're not accountants. They are not lawyers. They will not give you accounting advice, and they will not give you legal advice, and they should not give you accounting advice, and they should not give you legal advice. They are simply an intermediary, just making sure that the transfer is occurring the way it should with the appropriate documentation and contracts and assignments between you, the intermediary, making sure they hold the funds, and then they give the funds over to the seller, sorry, the buyer, no, right the first time, the seller on the replacement property, so that you are never in possession of the actual funds. By doing it that way is what we also call a delayed exchange. Another way to do it is an immediate swap, which is what used to be required, I think prior to 86, prior to 84, which made it very, very hard to have simultaneous closings. Very, very tricky. Okay. But nevertheless, the quick answer is no, they are not accountants. Got it. Okay.
Got one. If I was buying investment property in another state, is there something different to do or need another attorney?
Okay, so when you say another state, I'm going to assume you mean a state outside of New York. The quick answer is yes. If you're buying a property in any state, I would recommend you would obtain an attorney and you would obtain a qualified intermediary. Now, as far as something different, the law is federal. So the process would be the same. Everything that we discussed here today would apply. The only difference would be the state level of income taxes, whether they would cooperate. The only state that I can think of is Pennsylvania, with its exception is they don't necessarily play by the same rules as all the other states and acknowledge it for purposes of the 1031 exchange. Also, a side note, something to consider, if you reside in New York State and you purchase in another state and you were doing a 1031 exchange, well, then the question that comes up is, what taxes do I pay? We have the federal level, we'll have New York State, and then we have the other state. So we have a blending of taxes, and we would have one state potentially crediting as to the other. So you'd really have to make sure you have a seasoned and experienced tax advisor in that situation, right? Sometimes you may have, for example, you may live in California and you may have property in Florida. So Florida doesn't have an income tax, but California does. And so in that scenario, you may be hit, even though your property is in Florida, and Florida may not hit you with the tax. Because you were a resident of California on the state level, you'll get hit with the tax, and I believe California is 13%, right? My pleasure. Okay. I think that's it for the questions.
Yeah.
All right. Well, everyone, if there's no more questions, I'm going to thank you all for attending. I'm going to thank AHEPA for inviting me here today. It was my pleasure. If there are any follow-up questions, feel free to call. My telephone number is on the screen right now. You can call, or you can email our client services director at csd@growwithalawyer.com. And if you're interested in the book, I did see that some people showed some interest. We're going to take that and we're going to forward you over a copy of the PDF, complimentary copy, whereby you'll be able to discuss and read, rather, the basics of a real estate transaction. And it's geared towards the first timer, introducing the various parties. So you get a basic idea of who's involved in a real estate transaction, what role they play, why are they involved, what aspects, what hurdles that you'll need to be aware of. We also then touch upon the 1031 exchange, similar to what we discussed here today, and some additional detail. And then we touch upon the mortgage and the refinance and how that necessarily works. Okay. Great. Thank you, everybody. What I'll do is I'm going to turn this over to Brother Billy, our president.
Thank you, John. This is a wonderful, very informative discussion, lecture, and we hope our friends that will participating take advantage of the knowledge. Email you or call or visit the website for law.com, AOKOLAJIS.com.
Brother Billy, sorry to interrupt, but it looks like the staticky on your end. You're sounding very distant and very staticky. See,
Hear me now?
Yeah, you made me think it was my end. It was your headphones.
It was his headphones. So thank you again, Brother John, for a very informative and educational discussion. And we'll pass on the information to the participants that gave their email so they can get the copy of the 1031 exchange book. And if you like, we'll also keep you informed of any other of our activities. Thank you, everybody. Thank you, Brother John. This was great. We're going to do more of discussions on a monthly or maybe even bi-monthly. We'll see how we can work this out, at least on a monthly basis. I do a lecture on history. You do business. We can do our other brothers. They're into many different things: film, law, real estate, as well, and we can include them. And we'll also have more networking events, and also with our Daughters of Penelope chapter. Sister Effie's here. Thank you also for your work, Sister Effie, and all your help.
My pleasure.
We had a very nice group, a nice number of people attending, and we'll also share this video afterwards as well. So thank you so much, everybody. Have a wonderful July and August. We have many more events planned very soon, and we'll keep you all posted.
Thank you.
Thank you, everyone. Bye.
Thank you.
Bye-bye.
Bye.
Thank you again. Take care.
Thank you.